Hey everyone, welcome to Pajama Finances. Just going through every day talking about how I've been setting up different revenue streams and working to make money in a world where everyone is currently working from home. So today I'd like to talk about the stock market. Um, I have been investing lately in a lot of stocks. Usually putting in, only a couple $100 into each stock, but aiming to see somewhere between 8 and 12% return on stocks. So averaging about 10% right now. Um, Before we dive in, just to cover the basics, I am not affiliated with anybody that I will mention in this video. I don't have any ties to any of the companies. I will be talking about using Cash App. I have no affiliation with Cash App. Um, Besides that, yep, let's dive right in. So the first part that I think is most important to cover when it comes to stocks is it's an investment, but it's also very risky. So you have to treat it like it's gambling in a way, where the money that you come in with, you have to be willing to lose. Um, on that note, I don't recommend anyone putting in more money than they would be okay with not pulling out for a while, or at the very worst case, losing forever. Um, so don't put in the money that was going to be your rent payment, or that you need to cover bills or taxes or anything like that. As long as you're doing that, I think that investing in stocks can be a fun and smart way to make a lot of money. Um, there are big pitfalls, and we'll get into those later. Um, but I couldn't recommend enough that everyone get involved in the stock market. The next major thing is to find a way to invest in the stock market without a lot of fees or, you know, um, charges and whatnot. So I use Cash App. It's just an app on your phone. You can get it. If you do get it, you know, make sure that you tie it to a bank account. You don't rush transactions or anything. You should never have to pay any fees within Cash App. Um, I use it because it allows me to buy stocks, mostly from the New York Stock Exchange, and never charges a fee for any transaction. You can also use it as a wallet for Bitcoin, but it will charge you fees to trade in and out of Bitcoin. Um, that being said, too, uh, there are many other apps that allow you to do this. There are many other organizations that will do it for you. A lot of them will charge fees. Brokers will charge fees, and some stocks only, or some portfolio apps and whatnot, will only allow you to buy whole stocks, so buying in full shares. I don't recommend those because it's harder to get started if you're trying to buy Netflix stock and it's upwards of $250 a share and you've got $100 to play with. There just isn't much room to go there. Finding apps that will allow you to do partial stocks are great because you can invest any amount, starting with $100, $200. That's how I started, and you can sit and just wake up every morning, check the stock market, buy, sell, do whatever you want to do, and don't have to pay any fees, don't have to worry about putting in full amounts or working with a broker. Do it all yourself. Uh, I started with a couple shares of Apple stock. Um, I think about two shares of Apple stock, something like that. And I've now diversified into 26 stocks. So that is my second recommendation, which is make sure that you're diversified enough in your stocks that you're not risking it all on one company or one market. Say, for example, you wanted to invest in Apple stock. I wouldn't also recommend going investing all the rest of your money in Microsoft, Google, and Facebook, just because that's all big tech, and big tech is known for growing pretty well, pretty consistently as of late, but there is the risk if they all go down at the same time, that money is just tied up there, and unless you want to take a loss, you have to wait for the market to rebound. It's not a bad idea to invest in people that share the same market space. For example, Apple and Microsoft. If you do invest in both of them, they often go up in conjunction or in parallel with each other. So if tech as a whole is going up, both Microsoft and Apple will go up. However, if Apple releases a new product that competes with Microsoft, say their MacBook, that may send Microsoft shares down. It's not always the case, but in fields where there is overlap, occasionally one share, one stock going up means that another stock will go down. Again, none of that's tried and true, doesn't happen all the time, but there's always that risk. So sometimes if you invest in both, Google and Microsoft, you'll gain on both as the stock market rises, or lose on both, the stock market falls. Other times they'll go opposite of each other. That's kind of a truism, but it is something to think about when you're diversifying your portfolio, to make sure that you're buying into some into banking and finance, some into technology, some into restaurants, gaming, shopping, space it out. The other thing when it comes to diversification is understanding where the market is right now. If there's a stock that's really, really hot, say it was $20 a share a month ago and now it's $100 a share, that could be a good investment, but understanding where the market's at, you would think that might rebound soon, because that might not be a sustainable price for that. There are exceptions to these. You see things like Tesla stock growing 400, 500% in the same year or whatever. It happens, but there's a huge risk inherent in buying into a stock that's already gone up a lot. And for this example, we'll use Canadian cannabis companies as our example here. Lately, Canadian cannabis companies, Aurora Cannabis, Canopy Growth, a couple others, all went up drastically in price per share. We're talking, 50 to 200%, these insane growths. If you bought in when it was 75% up and it went up to 100% up, its month starting price or something like that, in essence, if you bought in at $75 and it went to $100, you've made 30%. That's great for you. However, someone that bought in at $10 and it went to $100 made $90 per share. So the return on investment slows as market growth reaches a peak or cap. You'll see a lot where some news will come out, some big release. For example, Canadian cannabis companies went up because a lot of states in the US agreed to legalize marijuana use, either for recreational or medicinal use. And regardless of your beliefs on marijuana, the stock went up because people thought that, hey, someone's going to buy the stock, it's worth investing in. The outcome of that was all the stocks balanced out at about 10 to 30% up what they were prior to the news breaking that the states were passing legalization measures. There's still a benefit there than if you bought in before that happened, but there would be a loss, potentially even a drastic loss, if you bought in when those stocks were at their peak. So just because a stock is going up doesn't mean that it will continue to go up. And I give the same advice if you're investing in something like cryptocurrencies, because people blindly hold a lot of cryptocurrencies, which can be good. Say, for example, if you bought in March of this year when Bitcoin was somewhere around $3,000 or $4,000, it's upwards of $16,000 now, so you would have made a lot. And if you had sold in the initial growth, when it hit 10,000 or 12,000, you would have made money, but you would have lost out on a lot of profit. But you can kind of see when markets might be hitting a cap, and if the return on your investment is good, it's worth maybe taking out some, if not all. And that brings us to dollar cost averaging, which is the idea that if you buy into enough stocks across the market and you buy and sell stocks, making profits generally, you can kind of play this game where you maybe don't get the best return on investment, but you always get a net positive. And this can involve buying, say, for example, 100 shares of something, and then when it seems like it's peaked, it's gone extremely up for you, to where you're confident that the return on investment is good. Say, for example, somewhere between like 10 to 50%. That's generally above market average for return on investment. If you see that kind of return, then you can sell maybe a portion of your stock. If say for example, it did go up 50%, so you now have 15. Say they were $100 a share at 100 shares, they're now $150 a share. You can sell off, say for example, half, which would be 7,500. My math is correct. The 15,000 that you have, and keep the other 7,500 just riding in the market. That way you're mainly playing on house money. It's not money that you put in. You're only maybe out then, a small portion of the money you put in. And on the smaller scale, you see this. If you invested in something that was impacted by COVID before they announced that there's a potential vaccine, a lot of those stocks shot up Monday of this week. And I had mentioned in a previous video that I invested in AMC. AMC went up about 50%. I did not sell all of my AMC stock at once because I figured if I sold out about half of it, I would not be in for very much money, and I could let that money play for a long time with still half of the shares that I initially invested. So as long as I could sell that eventually for the difference to make up what I had put in or more, it was worth letting it ride out. I maybe lose profits in the long run, but I had the potential to gain a lot, and I've mitigated a lot of the risk of putting in large sums. I do recommend this if you have lots of money invested. If you're playing on $100 and the stock goes up to $200, the dollar cost averaging there maybe doesn't make sense because you've got not a whole lot invested in the market. So in smaller cases, I would recommend either leaving it all in, or if you see some kind of growth like that where your money doubles, probably just taking it out. And that brings me to the next point, which is you can always put money back into the stock market, and if you're not paying fees to do so, to take money out or put money in, there is a benefit to buying on dips, selling on peaks, and even if they're relatively small. I frequently will buy a stock on like a Monday if it tanks for some reason, but I note that the stock in general is good. I might buy in for a decent amount, knowing that I may only get somewhere between 3 to 5% gain on it, but seeing that it did drop, and that could lead to a lot of profits. So the biggest downside of this is there isn't a guarantee. If you see a stock dip, obviously you can't guarantee to buy in. And if you're doing, what I mentioned before about putting money in and watching it go up, and you see really great profits, if you do pull it all out and it just goes up from there, instead of going back down and buying back in, you did miss out on a little bit of profit gain there. But as long as you're happy with the profits you're making, you can always put that back into the stock market somewhere else and reinvest it. Like I'd mentioned, AMC stock went up 50% and it dropped again, 50% from where I bought it. It dropped again to about 20% up from where I bought it. If I had sold all at the 50%, I could actually have bought back in at the 20%, then should it eventually go back up, I would have more stocks than I initially had. However, I'd also be buying it at a price that was higher than I initially bought it. So there's always a balance game to be played. And I think that there's no right answer there. But if you do see some profits that you want to take out, it's fine always to walk away with some amount. It's the same if you're sitting down to play poker or craps or something. If you put in $100, at one point you're feeling super lucky, bet it all, you make $200. You can just walk away with $200. That's there's no downside there because you did make a lot of money. If you put it back on the table, you risk losing it. So, sometimes it's keen to just walk away with the profits you've made. And that brings us to another major point in financial investment here, which is the profits you make can be your investments. So say for example you start with $100 in the stock market, you get a 10% return on your first stock investment, you sell out $110. You then can take the $110 and just reinvest that into your next stock. If you're always playing with essentially the first $100 that you got, there's not really a downside there because you've still only risked the $100. And if you keep getting, even only a 2% return, it's $100, $102. The next time you make, 2%, you're making $2.04. Then the next time you make, the 2% return, it's $2.08, and just continues to go up and up and up. So I can't stress enough how important just walking away with some amount of profit is, and not just blindly holding stocks. However, that also leads us to day trading and income versus capital gains stock investment. Day trading first. If you trade stocks by buying them or selling them in the morning and then buying or selling them at night, and you're buying and selling into the same stock, you might be labeled as a day trader. There are certain restrictions on day trading. I do not day trade, so I will not get into the specifics on that, but basically most apps don't allow you to be a day trader. It is seen as a way to shield yourself from potential loss if you, say, buy in the morning, stocks go up 2%, you sell at night, you buy back in the next morning after you've seen the stock, guarantee that it's where it was, you can keep buying and selling into that stock because the market will close every night, and you just keep buying on the ups, or if it goes down, you don't buy back in, or you do buy back in and it's now lower. So day trader has to have a certain amount of capital in the market and has to abide by certain rules. I don't recommend doing this unless you want to make this your profession. It's not the idea here. The idea here is to have a, semi-passive income stream, kind of actively managed, but not having to put a whole lot of effort in. And if you can do that, if you can find that outlet to just be able to invest some money and not turn it into day trading or turn it into professional trading, there are two ways to go about that then, which is, one, you just buy stocks and hold them. A lot of stocks pay dividends. Not every stock does, but a lot of stocks do. If you just buy stocks and hold them, you can get dividend returns on stocks. And they're usually marginal, somewhere between a couple cents to a couple dollars every quarter or yearly, depending on how they are paid out. And you shouldn't buy a stock just for the dividends, but if you are planning to buy stocks and just hold them for a long time and let them go up, dividends can be a good way of seeing consistent returns on the money that you put in. A big thing here would be if you're investing, say, $1,000 into a company, stocks are $25 a share. If they pay out 20 cents a quarter, you're looking at 80 cents a year per share. You may actually get some serious money off that in the long run if you're planning on holding it for a year, 2 years, 3 years. And then when you sell, ideally it will be far above what you bought it for. You sell out and you make money. You can also just hold stocks past their dividend date, get some money off that. If you still plan to sell in the short term, occasionally I do that, but for the most part, I don't buy stocks for dividends. Usually there are requirements on the dates. For example, one of the stocks I bought into is paying out a dividend on the 18th of November. You had to have owned the stock by the 11th of November, and then it will pay dividends again later. And the same concept will apply where you have to own the stock a week prior to the dividend date and still own it in that period, so holding the stock for a week. Frequently you'll see stocks go up slightly before their dividend date, drop during that 7-day period, and then depending on how well the company's doing, what the dividend payout is, the stock may go up or down or stay the same. The other aspect is if you do buy and sell stocks, not as a day trader, but every day or every week or whatever, you're not holding it for years on end. The federal government classifies that as income and not capital gains. And the difference between income and capital gains is the tax rate. Capital gains is taxed, I believe, at 20% federally. Your income bracket may be, well, it's 20% federally for the highest rates. So, if you're buying selling a lot of stock, that's what you're looking at. If your income rate is higher than that, and you're buying and selling stocks on the daily or monthly, you're not holding them for at least a year, you pay that as income tax, not as capital gains tax. And it's always based on your bracket. So, in essence, it is cheaper to hold the stock for long terms, so a year or more, if you're talking about tax purposes. If you're more focused on just seeing returns, shifting money around, moving around, you'll pay slightly higher taxes. You'll pay that as income instead of capital gains. But it may be worthwhile in the long run to not just hold a stock for the sake of not paying capital gains tax. I do think it is definitely a smarter long-term strategy to have stocks that you don't take out often, because taxes are charged on the profits on a stock. So if you bought stock for $100 and sold it for $110, you are paying taxes on the $10. Income as well is the same process. However, if you're constantly buying and selling stocks, you're seeing that applied to every transfer. If you keep stock in for a long time and the profits continue to go up, and you aren't just pulling it out and reinvesting it and pulling it out and reinvesting it, the taxes on it will just be that one time whenever you do end up selling it out. Dividends are also taxed as capital gains, so in general, it can be cheaper in the long run to hold stock for at least a year, buy and sell less often. However, the reward might not be as great, and if you have the time to actively manage your portfolio, you may see some significant returns. The last point I'd like to bring up is monitoring for news and for events, anything that you can do to keep on top of the stocks that you've invested and for potential stocks that you'd like to invest in. Cash App is nice because it will give you the most recent news articles related to the stocks that you've invested in and just in general related to the stock market. kind of puts them up in the feed. So you can kind of understand where stocks might be going. They might be saying, oh, Disney's going to see a dip, or, oh, a company is going bearish on a stock. And bearish means that they believe the stock is going to go down, and bullish means they believe the stock is going to go up. A bull market means the stock is doing well. If you see those, they can be good indicators of what other experts might feel. Sometimes they're just opinions. Kramer is a big one. Don't take it as fact because they're occasionally wrong. And obviously, some people are always wrong, or frequently wrong, because you don't see 100% or 200% returns. If everyone could always just assess the stock market perfectly, then there would never be any gaming to it, and everyone would have amazing returns, or be shorting stocks constantly. That's not the case. No one's going to be perfect with assessing the stock market, and you can see the news outlets on people's opinions like that. And you can also see news for what the company might be doing. So, for example, if they're holding a conference, an event, Apple holds events frequently, usually a couple a year. Sometimes when those announcements come out, if they announce new product lines or new investment strategies or something of that effect, it could send the stock up. If the announcement is something that is not well received, it may send the stock down. If the announcement is that they're going bankrupt, it may send the stock really far down, or non-existent. But on the whole, keeping up with the news on a specific company can be very helpful. The news may also be not related directly to that company. Say, for example, Pfizer announcing that they had a potential coronavirus vaccine. It's very good for the world, and it offers a lot of opportunities for in-person businesses to open back up. And if in-person businesses start opening back up again, they will see increased revenue, and so a lot of companies will, see their stock boosts because of that. Monday of this last week, stocks went up nearly across the board, even for not coronavirus impacted stocks, but specifically the ones that were impacted by COVID, restaurants, shopping, theaters, bowling, everything of that effect. A lot of those saw a bump because people were hopeful that that means that they would go back to business soon, or at least go back to some sense of normalcy. If you can catch those moments before they happen, if you are following science news, if you're following just social media, if you can catch them before they happen, if you understand that it's going to happen or predict that it might, say, for example, if you invested across the board in vaccine stocks, you would have seen maybe some bumps here and there. Pfizer stock has actually gone down since their announcement, which is curious, but I assume it will go back up come the time of the actual vaccine release. But if you can predict those, frequently, news such as that will either bring a stock up or down. So if you know that some bad news is coming, stocks will dip. If you know good news is coming, stocks might go up. Always good to buy and sell on those guesses, if they can be validated in some way. However, generally, as the public finds something out, it's almost too late to get on board. For example, if you had predicted that cannabis stocks in Canada would go up because you thought that the laws might pass, the different ballot measures, then you could have made a lot of money. But if you bought in when you saw that the measures had passed, it was almost too late to ride that wave. Still can risk it for some profit margins, but the return on investment is a lot lower. And you have to be careful too about where you learn this information. as a general sweeping statement, never commit insider trading. If you know something because of your affiliation with a company or because you know someone who's in a company and they tell you something and you trade on that information, you can go to jail for that. That's extremely serious crimes, and many people have gone to jail for that. So always be careful about how you learn information and where. And that will be, the final message is be careful about what you invest in, given your affiliations and your ties. If you work for a company that works closely with another company and you invest in that company, there's always the risk that you heard something or maybe assumed that you heard something, and you could seek, or you might see repercussions because of that. And this may even be the case if you don't directly work with somebody, but your company does. You may have to seek approval through your work for certain trades, particularly if you are in law, government, a lot of institutions where you see other companies, and you might be privy to information on mergers, acquisitions, bankruptcy notices. All those things will greatly impact your ability to buy and sell stocks. So, to go over our points, in short, always buy and sell only with the money that you're willing to lose. Keep money in for as long as you'd like. If you keep it past a year, that's generally the mark for capital gains versus income. Feel free to invest in whatever you'd like, but make sure to diversify your portfolio. Never trade on information that's insider information, because that can be a crime, and at the very least is something you don't want to risk. So always be wary about what you're investing in. And lastly, just don't be afraid to walk away with some profits. If you put $100 in, it goes down to $40 and goes back up to 105, it might be a good time to just pull out the 105 and walk away with the extra $5. Be smart about where you invest. Enjoy the process. It is fun. I wake up every morning and trade a couple stocks before I start working, so would highly recommend that for anyone who wants to go and get involved in that. If you do have any questions on the stock market, please feel free to comment below and let me know what you'd like answered. I'm pretty new to buying and trading stocks myself, just personally through Cash App, but I've had a 401k for a while and I keep a close eye on the stock market, so I'd like to think that I at least know the basics. But again, all of the advice that I give is not professional advice, it's just my own personal feelings on things, and I hope you enjoyed listening. Thanks, and bye.